Every war has a cost. But if you think the people who start wars are the ones who pay for them, you've been looking in the wrong place. Because modern wars don't arrive with ration cards or emergency taxes stamped across your salary. There are no long lines for bread, no visible sacrifice in the richest neighborhoods. In fact, something strange often happens instead. Markets rise, defense stocks surge. Politicians step in front of cameras and calmly reassure everyone, we can afford this. And that's the illusion, because wars are almost never paid for when they are fought. They are financed. And once you understand how war is financed, you understand who really pays. Welcome to the Financial Historian, where money, power, and history collide. And nothing is ever as simple as it seems. There was a time when war hurt instantly. In medieval Europe, kings didn't have complex financial systems or central banks backing them. If a ruler wanted to go to war, the choices were brutally simple. Raise taxes, seize land, or debase the currency by mixing precious metals with cheaper ones. No matter what they chose, the pain was immediate, and everyone felt it. Take the 100 Years' War between England and France. It dragged on for more than a century, from 1337 to 1453. Funding it meant squeezing every possible resource out of the population, peasants, merchants, clergy, landowners. No one was spared, and the consequences were predictable. Revolts, uprisings, instability. Because when people feel the cost directly, they push back. Spain learned this lesson the hard way in the 16th century. Under Charles V and Philip II, the empire stretched across continents, but so did its military ambitions. War after war drained the treasury. Even the massive flow of silver from the Americas couldn't keep up. The result? Sovereign default. Again and again. The bill came fast, and when it arrived, it shattered the system. Back then, there was no hiding the cost of war. If a king wanted conflict, he had to take money from someone immediately, and immediate extraction creates resistance. But then everything changed. In 1694, a quiet revolution took place, not on a battlefield, but in finance. The Bank of England was founded, and with it came a new idea, one that would reshape warfare forever. For the first time, governments could borrow large sums of money from private investors, backed by the promise of future taxation. Instead of demanding all the resources up front, they could issue bonds, essentially IOUs with interest, and people bought them. This was the birth of modern public debt. Now, wars didn't have to be paid for immediately. The cost could be pushed into the future. Britain used this model to finance massive conflicts against France, including the War of the Spanish Succession and later the Napoleonic Wars. By 1815, after defeating Napoleon, Britain's debt had climbed over 200% of its GDP. Today, that number would trigger panic. But at the time, something more important had happened. War had become manageable, not cheaper, just easier to sustain. Because instead of breaking the population instantly, the government could spread the burden across generations. Perpetual bonds, known as consols, allowed Britain to pay interest indefinitely without ever repaying the principal. The cost of war was transformed from a visible shock into a slow, invisible drag. And once governments realized this, there was no going back. By the time of the American Civil War, the model had evolved further. The Union didn't just rely on taxes. It issued war bonds and even printed paper money not backed by gold, known as greenbacks. The result? Inflation. Prices rose. Purchasing power fell. The cost of war didn't just show up in taxes. It showed up in what money could buy. World War I took this to an entirely new scale. Governments across Europe flooded their economies with debt. Citizens were encouraged, sometimes pressured, to buy bonds. Posters framed it as patriotism, a duty, and it worked. But it wasn't enough. So governments did something even more powerful. They printed money. The gold standard was suspended. Money supply expanded rapidly. And inflation surged across the continent. In Germany, it spiraled out of control. By 1923, hyperinflation had destroyed the middle class. Savings were wiped out. Entire lifetimes of wealth vanished. The currency collapsed, and with it, social stability. This is where a critical truth becomes impossible to ignore. Inflation is not just a side effect of war. It is a tool. When governments can't raise enough taxes and can't borrow cheaply enough, they print. And when they print, the value of money falls. There's no bill, no invoice, no official charge, but everyone holding that currency pays. World War II followed a similar path, but with more sophistication. The United States issued mass amounts of war bonds. Federal debt surged from about 40% of GDP in 1941 to over 120% by 1946. But after the war, something interesting happened. Instead of aggressively paying down that debt through taxes, the government used a quieter strategy, financial repression. Interest rates were kept artificially low, while inflation ran higher. Imagine earning 2% on your savings while inflation is 4%. You're losing money every year. But that loss doesn't disappear. It transfers from savers to borrowers. And governments are the largest borrowers of all. This is how debt gets reduced, not by paying it off, but by slowly eroding its value. Not through force, but through math. Now step back and look at the pattern. Debt pushes the cost into the future. Inflation spreads the cost across society. Financial repression hides the cost over time. And while all this is happening, not everyone is affected equally. Those who hold cash suffer the most. Those who rely on fixed incomes fall behind. But those who own real assets, land, commodities, businesses, often rise with inflation. During the 1970s in the United States, inflation surged, partly driven by war spending and oil shocks. Middle-class savers watched their purchasing power erode. But owners of oil, commodities, and real estate saw their wealth increase in nominal terms. Where financing doesn't hit evenly. It can't, because the system itself redistributes wealth. And this brings us to today. Modern wars don't feel expensive. There are no sudden tax hikes. No immediate sacrifices. Instead, deficits quietly expand. Government borrowing increases. Central bank balance sheets grow larger. When the United States entered conflict in Afghanistan and Iraq after 2001, it didn't fund them with broad new taxes. It borrowed. Between 2001 and 2008, federal debt doubled. 2 decades of war funded on credit. And just like a credit card, the bill doesn't disappear, it gets delayed. But delay doesn't mean escape, because debt must always be serviced. And as debt grows, it begins to shape everything: interest rates, inflation, policy decisions, even economic stability itself. At a certain point, inflation stops being accidental. It becomes necessary. A pressure valve. You saw this dynamic again in the early 2020s. Massive government spending, global disruptions, central banks expanding the money supply at unprecedented levels. Inflation surged across much of the world between 2021 and 2023. Official explanations pointed to supply chains and pandemics, and those factors were real. But underneath them was something deeper. When governments spend heavily and finance it through borrowed money, especially money created by central banks, the value of currency shifts. And it always shifts in the same direction, away from those who hold it. This is the part most people never see, because the cost of modern war is hidden. There's no single moment when you're told what you owe, no clear line on your paycheck labeled war expense. Instead, it shows up slowly, in higher prices, in weaker purchasing power, in opportunities that feel just a little further out of reach. The sacrifice is still there. It's just been redesigned. And once you see it, you can't unsee it. There are no ration lines stretching around city blocks. No letters arriving at your door ordering you to serve. In the modern world, war doesn't knock loudly on every household. Instead, it whispers. The cost is stretched across years, across balance sheets, across generations. Soldiers go to the front lines. But the bill is sent to the future. Wars are loud, explosions, headlines, speeches. But the system that pays for them is quiet. And it's inside that silence where the real transfer of wealth takes place. When a government decides to go to war, it doesn't walk into the wealthiest neighborhoods and hand out invoices. It doesn't knock on the doors of billion-dollar asset managers and say, "It's time to pay your share." Instead, it activates something far more subtle and far more powerful. A system that looks neutral on the surface. Bond markets, central banks, budget committees, all operating in the background, all appearing technical, even boring, but together producing outcomes that are anything but equal. So let's follow the money. When war spending rises, governments need cash. Fast. They get it by issuing bonds. These bonds are bought by institutions, banks, pension funds, insurance companies, even foreign governments. On paper, it looks clean, almost harmless. The government receives money. Investors receive a promise, repayment with interest, a fair exchange. But that's only the surface layer. Because in modern large-scale conflicts, something else almost always happens next. Central banks step in. They begin purchasing government bonds, often indirectly through financial markets. They expand their balance sheets. They inject liquidity into the system. Why? To keep interest rates low, to prevent panic, to make sure borrowing can continue. In simple terms, the government spends, the treasury borrows, the central bank stabilizes, the financial system absorbs. And just like that, the shock disappears. There's no sudden tax spike, no immediate austerity, no visible sacrifice. War becomes financially manageable. But manageable doesn't mean free. It just means delayed, because the cost always returns, not as a single bill, but as pressure. Pressure in the form of rising debt, pressure in the form of inflation, pressure in the slow erosion of purchasing power. And that pressure doesn't affect everyone equally. Look at who benefits first. During major conflicts like World War II, American industrial giants transformed almost overnight. Companies like General Motors, Boeing, and Lockheed shifted into wartime production. Factories expanded. Contracts flooded in. Profits surged. War didn't drain these sectors. It fueled them. Fast forward to the 21st century. After September 11th, wars in Afghanistan and Iraq generated trillions in spending. Defense-linked firms like Halliburton, Lockheed Martin, and Raytheon became deeply embedded in that flow of capital. Government contracts turned into revenue streams. Revenue streams turned into rising share prices. For investors holding those assets, war didn't feel like a burden. It felt like growth. This isn't about blaming companies. It's about understanding incentives. When governments spend heavily in specific sectors, capital flows there, and those positioned inside that flow benefit. Now, compare that to the average worker. During periods of war-driven inflation, something predictable happens. Prices rise faster than wages. Housing becomes more expensive. Energy costs climb. Food prices increase. But salaries? They adjust slowly, if at all. If your income grows by 2 or 3% while your expenses rise by 6 or 8%, you don't need a tax bill to feel the difference. You're already paying. This is what inflation really is. A tax without legislation. No vote. No announcement. No receipt. Just less purchasing power year after year. And once again, the impact depends on where you stand. If you own assets, real estate, stocks, commodities, you have some protection. Your wealth can rise with inflation. But if you're saving sit in cash, earning little to no interest while prices climb, you lose. Silently, gradually, consistently. After World War II, many governments faced massive debt burdens. But instead of dramatically raising taxes, especially on the wealthy, they used a quieter method. They allowed inflation to run higher than interest rates for years. This is known as financial repression. It works like this. If inflation is 5% and your savings earn 2%, you're losing 3% of your purchasing power every year. That loss reduces the real value of government debt. Savers pay the price. Debtors benefit. And governments, the largest debtors of all, benefit the most. No dramatic policy announcement. No political backlash. Just slow, mathematical erosion. Now step back again and look at the pattern. War financed through debt and inflation doesn't just spread costs. It redistributes wealth. And over time, it tends to concentrate it. During World War I, old aristocracies declined, but industrial capitalists connected to war production gained influence. After World War II, the United States emerged economically dominant, while much of Europe lay in ruins. American corporations expanded globally. In recent decades, Prolonged conflicts combined with low interest rates have driven asset prices higher. Cheap money flows into stocks, real estate, and financial markets. Those who own assets see their wealth grow. Those who depend only on wages struggle to keep up. And here's the uncomfortable truth most people never hear clearly. The system isn't designed around fairness. It's designed around structure. Those with access to capital, diversified investments, and financial knowledge are naturally positioned to absorb or even benefit from these shifts. Those living paycheck to paycheck are not. And then comes a psychological trap. Because the cost is so spread out, it's almost invisible. There's no single day of reckoning. No war tax line on your payslip. Instead, it shows up slowly. Slightly higher prices. Slightly higher debt levels. Slightly larger central bank balance sheets. Year after year. So gradual that it feels normal. But hidden doesn't mean gone. Take the United States today. Federal debt has surpassed 120% of GDP. Interest payments alone have become one of the largest expenses in the national budget. And that interest must be paid before anything new is funded. This limits choices. It pressures policymakers. It ties future decisions to past spending. And when interest rates rise, as they did in 2022 and 2023, the cost of servicing that debt increases sharply. Governments are left with a difficult choice. Allow inflation to continue and erode purchasing power, or raise rates and risk destabilizing the financial system. Neither option is painless. So where does that leave us? With a reality that's uncomfortable, but clear. Wars are financed by borrowing from the future. They are paid for by currency holders, by savers, by workers, by generations who never voted for them. You may never see a war tax, but you've likely felt it at the grocery store, in your rent, in your electricity bill. You've seen deficits expand, central bank balance sheets grow, money lose value. These aren't abstract numbers. They are the financial footprints of geopolitical decisions. Understanding this doesn't make you cynical. It makes you aware. Because once you understand how wars are funded, everything changes. You start to see why asset ownership matters. Why holding only cash can be risky. Why debt shapes policy in ways most people never notice. War isn't just fought with weapons. It's funded with bonds, sustained with monetary policy, paid through time. And once you see that, another realization follows. The people who design financial systems rarely design them to harm themselves. History may change its form, but the arithmetic doesn't. Governments borrow. Central banks accommodate. Currencies weaken. Assets adjust. Wages lag. Wealth concentrates. Every time. The invoice always arrives. Just not in the way you expect. And not for the people you expect. The final lesson is simple, but difficult to accept. Wars are almost never paid for by those who declare them. They are paid for by those who hold currency and those who rely on wages. In the years that follow, the system pushes the burden forward in time and downward across society while protecting those positioned above it. If you want real financial awareness, real independence, you cannot ignore this. You cannot pretend deficits don't matter. You cannot assume inflation is random, because the loudest events in history are often paid for by the quietest mechanisms. Wars make noise, but the system that pays for them, it operates in silence. And in finance, it's always the silent forces that shape your future. If this changed the way you see the world, subscribe. Because history doesn't just tell stories. It reveals patterns. And once you see the pattern, you start to understand where everything is going.